Are you ready to build, grow, and protect your investments? Welcome to the Index Investing Show, where we give you the tips, tools, and philosophy for reaching your financial goals. And now, your host, inventor of the Portfolio Report Card and author, Ron DeLegge.
Coming up on today's program, tips on organizing your financial life and a role model organizer to imitate. Also coming up, John Love, CEO at USCF Investments, will be joining the program. We'll be talking about Commodities. The firm manages 13 commodity-focused ETPs. That's an acronym for Exchange Traded Product, along with one broad commodity mutual fund. So John Love coming up a little bit later. Also, looking beyond gold, which is going to be a great tie-in, because I want you to understand that many investors make the mistake of attempting to use gold as a substitute for investing in commodities. And I'm going to explain to you on today's program why that is not the correct way to be doing it. A lot to get into on today's show. 844-305-7800 is the number. We're here. You can also tweet the program at Index Show is where you find us on Twitter. We'll get you caught up a little bit later on what's going on the Twitter feed. So let's begin our conversation. I wrote a piece for Financial Advisor magazine. I've been an outside contributor for several years now. And the piece focused primarily on gold as it relates to investing in commodities. And the focus was really to look beyond gold. Now, I know this is something gold bugs aren't going to like, but hear me out. Later this year, the Spider Gold shares, ticker symbol GLD, is going to celebrate its 15-year anniversary. In retrospect, GLD's launch was definitely one of the greatest innovations within the ETF marketplace, because what it did is it securitized physical assets, and thereby providing investors with greater liquidity and an opportunity to broaden diversification beyond just stocks and bonds. Now, although GLD has around $32 billion in assets and by far is the largest gold related ETF anywhere, and it continues to obviously be a popular vehicle, what I'm trying to have you hear is that investors should not be limiting their commodities investing to just gold. Now, before we talk about strategies for expanding beyond gold investing, I want to first explain to you GLD's structure, because it is quite unique. So each share of GLD is designed to represent 1/110th an ounce of gold bullion. So let's just suppose an investor wanted to get gold exposure. It's certainly a lot easier to open up a brokerage account and buy one share of GLD at around $130 per share versus buying 1 ounce of physical gold bullion, which trades around $1,300 an ounce. So that's one of the key advantages, less out-of-pocket capital to get exposure to gold. But the other thing, too, is that shares of GLD, unlike physical gold, shares of GLD can be hedged. They can be leveraged. They can be bought and held. And what this does is it provides the ultimate flexibility to owners. A lot more flexibility than simply buying and storing gold inside your closet. And so that's one of the reasons why GLD has become such a popular vehicle. But as good as it is, there's still some drawbacks. And one of the biggest drawbacks, or what you might say a pitfall, that I see investors making is using gold as a substitute for their market exposure to commodities. What's the problem with that strategy? Well, in truth, gold is neither a diversified asset, nor does it serve as an accurate proxy for the performance of commodities as a group. So, to obtain diversified exposure, you should be using as an investor a commodity fund that's broadly diversified, has exposure to the entire group, and would serve as a good proxy or barometer for the entire group, not just one commodity like gold. A perfect example of this would be ticker symbol SDCI. That's the USCF Commodities Summer Haven Dynamic Commodity Strategy No K1 Fund, ticker symbol SDCI, which holds a broad basket of commodities to agriculture, energy, and the metals sectors. And at any given time, gold will be held inside SDCI along with other commodities. So what you're getting there, again, is good core diversified exposure. And again, you avoid this mistake that many investors are making, attempting to use gold as a substitute for commodities exposure. It does not work. Again, gold is not a proxy for the performance of commodities as a group. It's just one commodity among many, many others. And so we're going to talk a little bit more about commodities investing and strategies. I want to talk about some of those energy commodities. We've seen a nice bounce in the price of oil. We've seen a good run also in oil-linked or energy-linked sectors, oil and gas, natural gas, as well as the energy sector within the S&P 500, ticker symbol XLI, which, by the way, is a top performer thus far in 2019. Had a rough year last year, but it's up just over 15% so far. But we're going to talk a little bit later with John Love, CEO at USCF Investments, about the commodities, latest trends within the commodities group. 844-305-7800 is the number. We're here. You're listening to the Index Investing Show. By way of reminder, if you missed our program last week, I did a portfolio report card on a $840,000 investment portfolio for DL in Northern California. And it was an excellent opportunity to dissect DL's portfolio in those 5 key areas: cost, risk, diversification, taxes, and performance. And we gave them a final grade of A, B, C, D, or F. So if you missed that show, you can listen via podcast at our website, indexshow.com. You can also listen at Spotify, YouTube, iTunes, or Google Play. So there's a lot of different places where you can listen depending on the device that you're using. But the point is that we make our show available every single week so you can listen at your leisure. And do give us a review. Let us know what you think about the program. And if you'd like me to analyze and grade your portfolio, where I analyze it and tell you exactly what's good and what's bad and everything in between, all you got to do is go to portfolioreportcard.com and get in touch with me. Well, coming up a little bit later, we're going to talk about tips on organizing your financial life and a role model organizer who I think is quite worthy of imitation. Also, coming up, we're going to continue this conversation about looking beyond gold, and also we'll get you caught up on what's going on the Twitter feed. 844-305-7800 is the number. We're here. You can also tweet the program at Index Show is where you find us on Twitter. I'm Ron DeLegge. This is the Index Investing Show. Stay with us. More when we come back. Be here or be nowhere.
You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
All right, let's take a look at what's on our Twitter feed at Index Show. Here's a retweet, Jennifer Alban, and she says, Feds Williams says in a downturn, they would consider quantitative easing or even negative interest rates. My comment on that is back to the future. In other words, the more things change, the more they stay the same. Here's another retweet, Wall Street Journal, saying that Trump's budget sets high expectations for economic growth. Yeah, I'd say it's not just very high expectations. It's actually pie in the sky expectations. Expectations that won't be met for sure. And remember, economists of all parties, of all colors, have accurately predicted 9 out of the past 5 recessions. That's how lousy they've been as a group. And that won't be any different in the future. Here's another relink or tweet. Lisa Abramowitz at Bloomberg posted a nice chart showing that U.S. debt to GDP is ready to pass record levels that were last reached in the mid-1940s, and that from 2020 to 2029 that U.S. is expected to spend $7 trillion on interest expenses alone. Well, I've been talking about this for quite some time, and basically what's going to happen is you're going to have national debt in 10 years is going to be $40 trillion. That's what the number it's going to be at. And that's only not even half the problem. The real problem is these entitlement programs like Social Security and Medicare. Medicare, of course, 5 times larger than Social Security, but these programs have been for a very long time weighing down the nation in terms of what they're paying out versus what they're taking in terms of tax revenue. And so, as I've said to you so many times on the program, there's only 4 ways to pay for this. And there's only really, actually there's 4 ways you can pay for it, but there's really only 2 ways they're going to be able to do it. So you can try to print your way out of the problem. Can't do that. It would devalue the U.S. dollar. And this, by the way, this experiment of printing has been tried in other nations, and it's never worked. I have in my possession a $100 trillion bill from the Reserve Bank of Zimbabwe. Zimbabwe has been in a hyperinflationary economy for a long time, and they're one of the economies that tried this. They tried to print themselves out of debt, and that's why they've got a $100 trillion bill, which I bought on eBay for $2, and that included shipping and handling. So it devalues existing money supply, so you can't print your way out of it. Can you borrow your way out of it? Well, there's nobody on the planet that has the kind of money that it would take to permanently fix the multi-trillion-dollar financial problems that the U.S. faces. Heck, China is just worried about getting their $1.5 or $2 trillion back from us. Why would they give us more money that they don't even have themselves? But you can't borrow yourself out of this problem, so that leaves you with 2 unappetizing choices. You can either raise revenue, which means increasing taxes, or you can decrease spending. In other words, cutting back, or some combination of the 2. And so what this means for all of us, when we think about retirement, it means that we're going to live our lives in a higher tax bracket during retirement. Now, I know a lot of you don't believe that, but that's what's going to happen. It's the opposite of conventional thinking. And so this is why we are big fans of Roth IRAs, Roth 401ks, Roth IRA conversions. And really, a big fan of tax-free retirement income. In other words, income that does not increase your tax burdens, income that is sheltered from the threat of higher future taxes. And the way to do that is by paying some taxes along the way and getting it out of the way now versus rolling the dice and waiting to see what happens later on after the current tax law expires at the end of 2025. That's not something that I think any of us should be doing, rolling the dice. So anyway, that's on the Twitter feed. You can read those articles on the financial trouble that the U.S. Government finds itself in. And these problems will continue to get worse because nothing is being done by politicians as they continue to kick the can. At Index Show, again, is my Twitter handle. So coming up a little bit later, John Love will be with us. He's the CEO at USCF Investments. We will be talking about commodities investing, some of the latest trends, and also we'll be discussing some ticker symbols of exchange-traded products that offer exposure to this very important asset class that many investors overlook or miss. Now, earlier in the show, we discussed why you should be looking beyond gold as an investment. Gold, of course, is just one of many commodities. And just because you own or have exposure to gold or even silver does not mean you have complete exposure to commodities as a group. Because remember, gold and silver are just two commodities within the entire complex. And so let's just slice this from kind of a different angle. Let's just say you wanted to invest in precious metals. Did you know that you could do that in a diversified manner? For example, ticker symbol GLTR, which is the Aberdeen Standard Physical Precious Metals Basket Shares. It's, again, ticker symbol GLTR. It's a 4-in-1 product that holds physical gold, physical silver, physical platinum, and physical palladium. So you've got exposure to 4 key precious metals. It's a multidimensional approach, and it charges annual expenses of just 60 basis points. That's 0.60%. It trades on a stock exchange, just like individual stocks as well as other ETFs. And it's a much more affordable solution compared to taking physical delivery of precious metals and having to store them. You're paying for storage, you're paying for insurance, and all that unnecessary process. And it also allows you to spread your bet as an investor across various precious metals versus a one-dimensional approach of just buying gold or just buying silver. So this is what I mean by looking beyond gold. Of course, the first way you look beyond gold is you get broad, core, diversified exposure using a commodities exchange-traded product. We mentioned SDCI earlier in the show. That's a good fund if you hold that one in your taxable account because there's no K1 tax form that is required or goes with it. That's very different than a lot of other commodity ETPs. But if you own a commodity ETP inside a tax-deferred or tax-free account, you could take a look at something like USCI, which is a broad, diversified commodity exchange-traded product. I think a very good core holding. You also have ticker symbol DBC as another choice. So these are some of the funds that you can look at in terms of adding exposure to commodities. So coming up next, John Love, CEO of USCF Investments. I'm Ron DeLegge. This is the Index Investing Show. I'll be right back.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show.
First, the basic idea. Working people defer the money they earn. Next, that money can be used in the future to pay for basic living expenses, so long as it's wisely invested. To acquire these skills, tune in to the Index Investing Show with Ron DeLegge, a carefully designed program for working people who save and invest money. The Index Investing Show is now available at iTunes, Spotify, YouTube, and other world-class platforms.
You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
Well, commodities have staged an impressive rebound in 2019, and here to talk with us about that is John Love. He's the CEO at USCF Investments. John, welcome back to the program. Great to have you with us.
Thanks, Ron. Great to be back with you.
So in your crude oil update from December, you said that, quote, "We view the correction in oil prices as overblown, and prices will likely notch higher in coming months," end of quote. I got to give you some kudos for making that very bold call. Moreover, it's been the correct call, as we've seen here a pretty nice upswing in oil prices. So tell us, John, what's been driving crude oil higher since the start of 2019?
Sure. Well, things at the end of the year seemed a little more clear cut than they normally do. The main cause for the drop in oil prices from October through the end of the year had really been addressed by OPEC at the end of November. And I think the market was just waiting, as they always do, as it always does, to see OPEC come through on what they promised. But I think we've seen over the last couple of years that OPEC has been very true to its word and is very driven to maintain their status and ability to keep a floor on prices. So. In a little more detail, what had happened is that prices had risen quite dramatically since 2017, and by 2017, U.S. production was very high, and there were concerns that we were actually getting heading towards an undersupplied market. So OPEC actually started pumping a little bit more oil, still within the bounds of the cuts they had announced in 2016 and had enacted in 2017. But they basically were trying to keep prices from going too high. And due to trade wars and due to the Iranian sanction waivers that the U.S. granted, we actually ended up with an oversupplied market after years of improvement. So OPEC agreed to cut more barrels, and I think the market, just because of the fears that were out there, the oil market continued to plunge, and it would probably be below the level that one would expect given the improving picture based on what OPEC had promised to do.
Ticker symbol USO and USOU both track crude oil. Of course, USOU aims for triple daily exposure. That particular leveraged ETF ahead by almost 80% since the start of the year. One of the best performing leveraged ETFs thus far this year. Now let's talk about the emergence of electric vehicles, John, and the clean energy movement, which has caused some to proclaim the coming doom or death of fossil fuels like gas and oil. So do you think that those arguments are overblown?
I don't think it's certainly a concern for oil producers, and the reality is that electric vehicles will have an impact. I don't think, though, that it's the doom of fossil fuels by any means. If you look at the government's own analysis, it looks like oil production in the U.S. will continue to grow for the next couple of years, and then it kind of levels off. And I think it's really the next decade, 20 or out to 2030, where we start to see some diminishment in oil production, oil supply. And but if you really take it broad, really step back and look at the picture and the government's projections out to 2050, although there's a bit of a diminishing supply, it's fairly flat out to 2050. So for the next 30 or so years, there's still expected to be a strong demand for fossil fuels. Now, it'd be wonderful for the environment if electric vehicles and other sources of energy did curtail emissions and things like that. But I think we'll continue to see continued use of fossil fuels for a while because quite simply the supply isn't there on the renewable side to replace them, and they'll remain the biggest source of energy in the U.S. and likely around the world for some time.
If you're just joining us, you're listening to the Index Investing Show. We're pleased to be talking with John Love, CEO at USCF Investments. They manage a lineup of commodity-focused exchange-traded products and one mutual fund. Most of the commodity products are focused on energy commodities like oil, natural gas, gasoline, but they also manage broadly diversified commodity ETPs and a fund. So go to uscfinvestments.com for more information. So let's talk about traders which have, as a group, historically used futures contracts to invest in and to trade commodities. Now, your firm, USCF, offers a lineup of exchange-traded products tracking various commodities along with USCI, which does it more broadly. So why would a trader or investor want to use a commodity exchange-traded product versus using futures contracts?
Well, I think the main reason is it just makes it easier to hold a position. If you trade futures and you're an expert trader, you don't have to manage futures contracts expire, so you have to roll them in order to maintain a position. You have to maintain appropriate margin, and you could get a margin call. They can be confusing to invest in than just equities. And what's interesting is we find that even what we were trying to do when we launched USO and our other commodity funds was sort of democratize the investment landscape and turn the future into an equity, into a future strategy, into an equity strategy. But we found that even professional investors use USO and other funds because of the advantages it offers and the ease of use of trading equity versus future contracts. So I think it just takes the complexity out of it and makes it a little easier for investors at the end of the day.
Compared to other major asset classes like stocks, bonds, and real estate, commodities have been beaten up for a very long time. We've talked about a reversion to the mean coming, and I think we're already seeing that, at least the early stages. But this is going to catch a lot of people who did not have exposure to commodities by surprise. How do you see it?
I think you're definitely right. Over the last decade, obviously, we've had a stellar stock market. We've had a 30-year bull market in bonds that really just came to an end by most prognosticators' estimates last year. So the commodities over the last 10 years have really underperformed. They did notch up in the last couple of years, and then we hit a little interruption with the trade wars and tariffs and all that kind of thing. But they tend to do well near the end of a market cycle, and that's kind of where we are. So I think of all the things, if you look at stocks, bonds, commodities, there's only one that has really performed near the bottom of its historical basis, and if there's any asset class that has an opportunity to run right now, it could be commodities.
Well, thank you for that insight, John, and taking the time to join us. Again, you just heard from John Love, CEO at USCF Investments. Go there, uscfinvestments.com, for more information. Well, I wanted to alert you before we go to break by a couple of ticker symbols that track commodities. If you're looking for broad core exposure and you have money in a taxable account, check out ticker symbol SDCI. That's the USCF Summerhaven Dynamic Commodity Strategy Fund with no K1. So it simplifies the tax reporting process. Again, that's ticker symbol SDCI. 844-305-7800 is the number. We're here. You can also tweet the program at Index Show is where you find us on Twitter. Well, I'm Ron DeLegge. This is the Index Investing Show. It's time for us to take a quick break. More when we come back. Be here or be nowhere.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show. You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
Now, here's one other final way to look beyond gold and to get exposure is to use commodity-linked industry sectors that are, of course, equity-based. So, for example, ticker symbol GDX, which focuses on gold miners, would be an example of that. Ticker symbol NUGT, which aims for leverage exposure to gold miners and is a cousin of GDX, is along the similar strategy. Of course, NUGT, again, uses triple or 300% daily leverage, so it's a very volatile and more of a trading tool that's short term. And then, of course, ticker symbol XLB, which is the ticker symbol for the sector Spider Materials. That's the material sector. Again, ticker symbol XLB, which owns 25 different stocks that are involved in industries such as chemicals, construction materials, packaging. You also have some metals and mining companies, paper and forest products. Some of the largest holdings within XLB, that's B like boy, Dow DuPont, Monsanto, Praxair, and Ecolab. And this particular sector is one of the smaller industry groups within the S&P 500. It represents less than 3% of the overall weight within the S&P 500. Yet, take a look at the incredible performance so far for XLB this year, ahead by almost 11% and outperforming the broader market. So that's been a good trade, and we have seen a resurgence in commodities prices, as we discussed earlier with John Love at USCF Investments. The short-term trend has been going up. And so these are ways that you can play that and participate in that without having to bank all of your money on a single physical metal like gold or silver. The other thing I want to mention is that if you take a look at just the trend, gold and silver are not really the story in terms of where the action's at in terms of precious metals. Palladium is now where the action is. It's being driven by higher emissions demand. It's also being driven by battery demand and limited mining ability. And it's got a great fundamental as well as a technical story. And over the past year, the ETP linked to palladium, ticker symbol PALL, which tracks physical palladium, it's jumped over 150% over the past 3 years compared to just about a 1.5% rise in gold and almost a 2.5% decline in the shares of the ETF linked to silver, ticker symbol SLV. So you can see palladium by far has easily outperformed gold and silver, so that's where the action's at. And we're just seeing an overall decline. And I think the economic importance and also the utility, the economic utility of gold and silver compared to something like palladium. Also, you've got the rise of these alternative stores of wealth, like these digital cryptocurrencies like Bitcoin and Litecoin. And I know that they're stuck in a bear market, but that will change. And as society becomes more familiar and comfortable with digital currencies, it could further erode gold's role as a haven for protecting wealth. So that's just something to think about. I encourage you to go to our website, indexshow.com, and check out some of the courses that we have built for listeners just like you. I've got 4 courses that are all online, and I'm going to just tell them to you real quick. Start Now, a rescue plan for retirement late savers. That's course number 1. Course number 2, how to fix hidden flaws inside your portfolio. So have you ever wondered why your performance is not as good as you think it should be? Or have you ever wondered, well, what's sinking my portfolio's performance? Or why am I not making as much as I should be? What is the cause of that, and how do you fix it? So it's all about identifying the problem and then fixing it. Well, that online course will help you do that. And then I've got 2 more courses. One is called Profit During Crashing Markets, a step-by-step guide. That was a popular course, especially in the fourth quarter of 2018 when everything was going down. Well, the time to be taking this course is right now. When things are good and skies are sunny and blue, not when it's raining cannonballs. At that point, I'm not saying it's too late, but at that point, you want to be ahead of the curve is what I'm trying to tell you. Then finally, my flagship course, which really is a must for all investors and all retirees, Build, Grow, and Protect Your Money, a step-by-step guide. So those online courses, again, available at indexshow.com. Just hit the link and you'll be taken right to the enrollment page. So let's talk about what I discussed earlier, tips on organizing your financial life, and a role model organizer who I think is worthy of imitation. Who am I talking about? I'm talking about Charles Dow, who I think can be counted among the greatest financial organizers of all time. Now, this is the same individual who created the Wall Street Journal, but he also introduced something called Dow Averages, and he single-handedly ushered in this new era of yardsticks that would keep track of the stock market's performance. And so Dow was really a master organizer, and that led, of course, to later versions of his work in the form of market indexes. Today, there are millions of indexes tracking not just stocks, but a variety of different asset classes, including bonds and currencies and commodities and real estate. I mean, it's endless. Standard & Poor's alone has over 1 million indexes when you count all the industry sub-indexes. Pretty amazing. Dow, I think, did a great job of organizing and mastering the art of organization. Now, what can we learn from him? What are the things that we can imitate? Well, first of all, applying this to you and me as individuals, first of all, set your retirement savings, for those of us that are still in the accumulation phase, on autopilot by having a portion of your earnings automatically deducted and saved in a reoccurring manner. Also, consolidate your investment accounts to make them easier to track and manage. Declutter investment holdings that are too similar or maybe overlapping with others that you already own. How about those old retirement plans still sitting at your previous employer? If you've got one or more of them, roll them over into a traditional IRA so that you can manage them and consolidate them in one place. Make it easy for yourself. And then, of course, create a written retirement plan that's mathematically tested. And also, on top of that, you should have a written investment policy statement which tells you what your asset allocation should be and describes your investment process, your investment goals, your investment philosophy. Those 2 documents go hand in hand. And then don't forget to complete your estate plan by executing a will and a trust and making sure that you also check your beneficiary data to make sure that's updated. Anytime someone gets married or has children or grandchildren or gets divorced or passes, these are good times to take a look to make sure that your beneficiary data is up to date. And then construct a grocery list of stocks, ETFs, and other investments that you'd like to buy at bargain prices during the next market downturn. Well, that does it for another episode of the Index Investing Show. Please join us again next week. We'll be here same time, same station. And until we meet again, may the market indexes be with you.
Thank you for listening to the Index Investing Show with Ron DeLegge. Connect with us on the web at indexshow.com. And be sure to subscribe to our podcast at iTunes, Spotify, or Google Play.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.